I share my screen here, we are technically back into a bull market. If I look at our investing signal here, we've got, after the COVID crash, we had a re-entry. The market rallied 40% We had an exit point. The market sold off for 2022. We had a new entry point. We're technically, in another bull market right now. The question is it a short bull market and it sells off in a big way in the near future, or does it keep going up?
Chris Vermeulen is back. He is a chief market strategist at thetechnicaltraders.com. Welcome back, Chris. We're going to get your market outlook today and how you're positioned. Good to see you.
Hey, thanks for having me, David. Always a pleasure.
We were talking offline about the markets. Not a lot has changed since a month and a half ago. Markets are still feeling, sentiment is still euphoric, and we'll talk about that. Before we get into your outlook, let's start with your current positioning first. What are you doing right now with your trades, and we'll go from there.
Sure. Yeah. Well, we're long the equities market. We're long the SP 500. We're long the NASDAQ. We've got some leveraged positions in there like QLD, which is a 2 times leveraged NASDAQ. It's up over about 40% right now. Our SSO, which is a 2 times leveraged SP 500, we're up about 25%. So we're long the markets. Now, you and I have talked about this. I'm bearish long-term. I think markets are setting up for a big correction, but just because I'm bearish doesn't mean I'm actually have a bearish position on. This is where I think actually a lot of listeners, a lot of individuals get sucked into people's opinions. I might say I'm really bearish, which I am, but it doesn't mean you go out and you take a bearish position. We're long, we're riding this trend because we follow trends as a technical trader. And when the markets turn around, that is when we take advantage of it. Opinions are just that. You have to trade the charts, not opinions. So that's one thing I try to always make clear because people get that very confused.
I think for some people who may be new to your work, they're wondering, why is this guy bearish but long? Can you explain that?
Yeah, so I'll show a visual of why that is here. Let me share my screen. And so if we were to talk about why I'm bearish, long story short, I won't go over this in great detail, but there's 4 stages to a stock market. I believe we are in a stage 3 topping phase, and we're in this rally mode where the market can come up. It could even put in a double top. It could even pierce to a nominal new high, which I have a feeling may happen. But after a stage 3 topping phase, we go into a stage 4 decline. And these are major. These don't happen often. A stage 4 decline was the tech bubble burst in 2000s. It was the financial collapse in 2008. Those are stage 4 declines. They are severe. They are a financial reset across most asset classes. They do a lot of damage to individuals. And so I think we're in this rally mode right now. And the market always has to apply maximum pain to its investors. And right now, if we were to just take a look at this from an emotional standpoint, because as you mentioned, people are kind of in a euphoric phase. We're actually in this complacency move where people are getting very excited. They're very bullish. They're piling into the stock market. And the market, everyone needs to get long before the market is going to start to sell off and go down. So I think we're just seeing everybody pile into specific stocks and sectors right now, chasing prices higher.
Why can't, I'm just looking at this chart, why can't we be in the optimism phase where, it's going up, but it's going to go up more?
Well, I would argue that kind of optimism and complacency are the same. The question is what comes after this rally. Does it break down and start making lower lows and we go into a stage 4? Or do we actually have a breakaway rally and it just keeps on going up and up and up? And that's why we, as a trader or an investor, we need to use technical analysis. We can't try and guess tops or guess where we are. If the trend keeps going up, we're going to ride this market up. If it rolls over, we're going to exit. We're going to take advantage of the falling trend. So that's the nice thing about being a technical trader. The news, I don't care what happens in the news. I don't care what goes on, what the Fed does. All that matters is if the trend is going up, we need to be positioned for it. If it's going nowhere, sideways, we will be in cash. If it's falling, we're going to find a way to take advantage of falling prices. And it removes all the stress, all the anxiety, or most of it anyway, because now you don't need to read opinions. You don't need to watch the news. And all we have to do is follow price. And we've got very good strategies of multiple different timeframes on how we want to follow price and how to do that in managed positions.
Well, how long does the complacency period last usually?
It could last a couple months. It could last a year or two. It really just depends on how long the market takes to work itself out. A lot of people got damaged after the COVID kind of crash in 2020, 2022. And, they're still licking their wounds, but they're starting to move back into the market right now. All the stocks that were kind of in this euphoric phase, this thrill and this huge move right after COVID and early in 2021, before small caps topped out, those are the same sectors that are coming to life right now. The same aggressive traders are piling into marijuana stocks, technology, growth, all the ARK ETFs, clean energy. So money is piling in the same ones that got hit the hardest last time. And that's telling us that, the general masses are becoming very bullish. They think 2022 was the bear market. They think we're starting a new bull market, and we are in a new bull market, you could argue right now, but I do think it will come to an end. And we need everybody to get bullish, just like they are. And the last time you and I spoke, it wasn't quite this severe. The difference over the past month is, in the last month, we're seeing all the same sectors that the COVID crowd bought into is coming back to life. And that to me is a warning sign that the top is almost here. Usually everybody piles in, they all buy the same stuff. They buy their risky, volatile assets just before a trend ends. And I think that's going to be a very interesting angle going forward here. But you got to ride this trend up until it does end, for sure.
So yeah, maybe we can switch to a live chart, and maybe you can show us a few of the technical indicators. I know you look at a holistic approach and you look at a lot of things, but maybe just show us a few things you look at to determine whether or not what's next could be either, like you said, a breakaway run, which is the optimism phase, or a massive correction, which is the complacency phase.
Yeah. So for example, here, this is the ARK ETF. This is a great gauge of what aggressive traders want to do. So you have a stage one, and then this was the COVID crash, and then it took off here, and it went into this euphoric phase, and then eventually crashed, and then it traded sideways for more or less a year in this complacency move, and then it went into a stage 4 decline, and now it is consolidating. I do think it's probably going to end up going a lot lower, into the lower teens, but when we look at the markets here, we're seeing the ARK ETFs come right up there. Everything is getting into a resistance area on the charts. We might see it squeeze up a little higher, get a lot of people really long, and then potentially roll over. This is kind of what we're looking for in the SP 500. If we were to go to the SP 500 and we take a look at the chart, eventually we could see this. Depending on how you want to look at it, this is like a big complacency rally. There's kind of a base here that we could come up for a double top. And especially if we hit nominal new highs, if we can break this high by just a little bit, it is going to be mainstream media news, stock indexes at all-time highs. We're already seeing this kind of runoff phase right here. Everybody's piling into the growth stocks. As soon as they start hearing we're at all-time highs, people are going to be like, that's it. We're in a new bull market. This is it, another 5 to 10 year rally, and they're going to get very committed. And that's usually right when the market puts in a very sharp correction, and we can go into a pretty big correct kind of stage 4 decline. If we go way back here, you can see in 2007, 2008, the market put in kind of a consolidation through here. It's very, very crunched down because of the rally since then, but it went into this massive, 50+% sell-off. And so right now we're in this complacency stage. This one was short-lived, but it can very easily come back up to test these highs. So that's kind of where we are in the grand scheme of things. I think we're going in for a major double top. That is going to suck in the most amount of investors and traders to get back into the markets. If we were to go back real quick here and zoom into 2008, you can see there was a pretty big pullback. It went up and it hit a nominal new high. It literally only ticked higher for like a day or two, and then it started a 50+% correction. And so this kind of little double top formation is what the market loves to do: poke to a nominal new high and then crash. If it's in a downtrend, it'll when it puts in a bottom, it'll like to poke to a nominal new low when you hit an extreme, and then have a huge rally the other way. So we could very easily see this stock market continue to climb maybe poke a new high. And then if it loses that momentum and goes into a big sell-off, I mean, we'd be looking at a 30 to 50% sell-off, I think, in the markets. Some people are calling for a much larger one than that, but I think that's actually a fairly conservative downside target if this was to happen. Again, this is just analysis. This is just opinions. Right now, we are long and we're riding this up. But the problem with most traders and investors is they don't have an exit strategy. So when things do start to roll over, they don't get out. And eventually they hold on to it a little too long. And they're like, well, I'm actually down too much. I don't want to take the loss. And then things keep selling off for the next 3, 6, 9 months. And you lose 50% of your value of your portfolio or your account value. And you're stuck in that position. So the key is to take advantage of these trends and have an exit strategy so that you can move out of those. For example, if we take a look, like I keep the strategy very simple, red and green bars. When it's red, we don't want to be in the market. This is the NASDAQ daily chart. Here's our signal on the QQQ. You could apply leverage to these like the QLD, which we're long, it's up over 40%. You could do the triple Qs, you would be up triple that more or less. But it's very straightforward. We peel off some partial profits and we can ride these trends until, from a technical standpoint, they reverse direction. It's the same with the SP 500. We're up a little less than that. It hasn't had quite the move, but overall, you got to be along the market. When the tide is going up, when the ocean water is going up, you want to be, in the stock market, because that's how I see it. The stocks on average are going up or they're going down, and you want to make sure you're on the right side of that tide.
So, Chris, I have to ask you for confirming indicators there, because right now you're long, you're riding the wave. So I guess the question is, at what point do you either you yourself as a trader reach an inflection point, meaning where we either reach a phase where the top is in and it's time to go short, or it's time to sell your positions and stay on the sidelines, meaning we're entering a bear phase. That's scenario number one. Scenario number two is you've entered a phase where you're psychologically ready to change your mind, meaning, okay, we've confirmed that this is going to be a renewed, sustained bull rally. I'm going to stay long and I'm going to turn bullish. So at what point do you make either decision?
Right. So the nice thing about okay, let's step back. So when the market starts to roll over, so because we're following price, we need price to trade sideways for a long enough period of time that it loses that upward momentum. It stalls out, or it has to start to sell off and move lower. And then it'll also tell us, hey, this trend is now going down. So just price action alone is one of those. We also like to use cycle analysis. We like to use moving averages. We like to also compare different assets. What is the SP 500 doing in relation to utilities, like utility sector? Because utilities and consumer staples are seen as a defensive play. When people get nervous, they start to sell some of their leading stocks, or the smart money does. They sell some of the growth stocks, and they start to go to toilet paper, toothbrush, electricity, running water type of companies that, if the world falls apart or the financial system, we still need all of those things. So, if the utilities start to come back to life in the consumer staples and even healthcare, then we know this market is actually getting a little long in the teeth, and the stock market might be getting ready for a pullback. We actually saw this just before the COVID crash. Utilities skyrocketed. They outperformed the indexes dramatically, and then everything fell apart with the stock market. It's a good early warning sign. And you look at consumer staples; they've been moving up the last couple of weeks. Healthcare has rallied, very tight bullish pattern. So these defensive sectors are starting to come to life, and that is a little bit of an early warning sign. So again, going back to your point, we wait for price to reverse direction. And then we look for what is the next best way to take advantage of a sideways market or a falling market. What asset is moving in a clear upward direction? And we'll go and we'll find that. In terms of knowing when we're in a full-on bull market, we are technically, if I share my screen here, we are technically back into a bull market. If I look at our investing signal here, we've got, after the COVID crash, we had a re-entry. The market rallied 40% We had an exit point. The market sold off for 2022. We had a new entry point. We're technically, in another bull market right now. The question is it a short bull market and it sells off in a big way in the near future, or does it keep going up? we're going to remain long with our investment position, which this is the weekly chart of the SP 500. As long as this market keeps going higher and the technicals confirm, it could last 5 or 10 years. Who knows? It might roll over in the next month, in the next 3 or 4 bars. So again, it really just comes down to following the market with different strategies, different timeframes, and having a strategy to roll out of those positions and re-enter them as price rotates from an uptrend to a downtrend. And sometimes, the best position is for long-term investors is to do nothing, move aside, sit in cash, avoid the chaos, or move into a strategy that can benefit from it. Like we did with the lower strategy here, which is our CGS, our consistent growth strategy. We had a few very small trades. They were short-lived, but we ended up turning a profit during the time when the stock market and bond market was down about on average 20, 25%. And so we can dance around this market. If the tide is up, we want to be more aggressive. We want to be in the market. If it's down, we dance around it, find safe, low risk trades, get into those trades. And we just navigate the market from that regard. The biggest thing here is we always focus on managing risk. We are always trying to cut our risk, reduce our exposure to the market as soon as we can, because as long as you're avoiding losses, then your account's going to keep going up. And that is the whole point of our strategy. That's why it's called the consistent growth strategy. Like just a visual of that is right here. If we take a look at this is our consistent growth strategy. And, during 2022, the stock market had a huge correction and pullback. Our account just kept going up every couple months. We're hitting a new all-time high. We actually just hit new all-time highs again last week on our account. And, the stock market, the NASDAQ's had a massive rally, and it's not even near its all-time highs yet we keep hitting all-time highs. So people get blinded by a huge rally in the markets this year. But the reality is they're still below the highs. You're just recovering lost money at this phase versus a strategy that focuses on consistently growing your account by avoiding the corrections in the markets and then stepping back in when they're going up. We just keep ratcheting our account higher and higher, slow and steady. There's no grand slam trades generally. Those are just a one-off here and there. We usually just have a bunch of small winners, and we just keep plugging away with really little drawdowns.
There's been a couple of times in history where you get a period of mass euphoria where people FOMO in. That's right before a top. Is that what's happening now? Are you seeing any evidence of that going on?
I think that's what we're starting to see. I don't think we're going to have that big euphoric phase like we saw like January, February of 2021. I don't think we're going to see quite that type of a blow off phase, but I definitely feel I see it, I hear it, I'm reading it in our emails. People are piling into the markets. They feel like they're missing out. A lot of people are looking at the market's performance in their portfolios. And if they hold any bonds, they're like, why am I not making money? People feel like they're missing out on their rally. So they're naturally moving into aggressive stocks and starting to chase things higher. Yeah, I totally feel the euphoric phase is building. And if the stock market can go up for that double top and just all it needs is 1 cent above the previous high, and it is going to be like earth shattering for people to pile into the markets. And I think we could see institutions, and that's when we could see big money distribution. So huge funds, institutions unloading big blocks of shares into the average investor, because I think a lot of them do see, the music's going to come to an end, but they're not the ones to force the trend, right off the hop. If buyers are buying, they're going to keep selling into these, and we're not seeing them overload the market yet. They're actually riding this market higher. And I'll be watching for that. I always talk about it with subscribers. I watch the intraday charts sometimes, and I can see when the big institutions are unloading massive blocks of shares.
That was my next question. Do you have any data to show whether or not the people piling in are institutional players or the retailers?
You never really know who they are, but I filter my time and sales window, and I like to look at who's doing big blocks, especially in the futures market, who's moving millions of dollars or tens of millions of dollars per transaction. And you can also look at the tick data. You can look at volume on short-term charts. When there's huge down volume, or a huge down move? Was the volume to the downside? Did they just like hit the bid and unload? So there's kind of, you have to really kind of finesse it and get a feel for it. But yeah, you can totally see when there's big institutions dumping shares. And some days you'll see them dump like every half an hour or 45 minutes, they dump tens of millions of dollars, if not hundreds of millions of dollars. And it just drives the market down. That's why you get these stair-stepping price actions down on a long sell-off day. And same with a rally. They'll do the same buying on the upside.
Let's compare some indices now. So the Russell 2000 has underperformed the S&P 500, and that's because a few of the bigger names in the S&P 500 have led the entire index up. When you see something like that, Chris, do you think it's maybe time to go more long on maybe the more undervalued index, or perhaps it's kind of time to go short on something that's gone up more, like the S&P, or specific names within the S&P that have gone up, like the tech stocks?
Yeah, so the Russell 2000, I generally look at it as kind of a leading indicator. So it put in a pretty major topping phase and broke down in 2022, and it has been trying to carve out a bottom here for a while. As you can see, it is right at resistance. Every time it's hit here, it has sold off and gone back to the lower end of the range. Small caps typically lead. I find they lead the general market, and we've got the SP 500, we got the NASDAQ, the Russell. I think the Dow is probably in a similar boat. It might be doing better with energy stocks. It has kind of popped above this resistance area, but everything is getting up into the next resistance zone. And over the next week or two, it's going to be very interesting to see how this market reacts, because Russell 2000 is showing signs that it is at resistance, and we have been seeing some big volume spikes to the downside. So there has been some distribution going on, and we're getting up to resistance. But if the Russell starts to sell back off, it's going to be a bearish sign, and the Russell should break down first. The Russell's refusing to break out. It has had a rally, but it's definitely nowhere near where the NASDAQ or the SP 500 is. So I do like to keep my eye on it. It gives us an idea of what the small cap kind of stocks are doing. But I mean, at this point, it is a giant kind of pause, a bear flag before actually heading lower. This is the stair-stepping price action where you pause, you sell off, you pause, you sell off. And again, we're in a big rotational phase, this topping phase, I think, that's going to still take, I think, a few months to work itself out at least.
Yeah. So generally, I think my question is whether or not you have a bias towards small caps or large caps right now in your long position or your outlook overall.
Yeah, I generally don't get too involved in the small caps. I like to trade more so the indexes. I think right now we are seeing small caps and growth stocks rally. I'm not so much into the small, really volatile stocks so much anymore. I like the large caps. I like the indexes. That's kind of my bread and butter. That's where I can consistently pull money out. I don't have to worry about a massive move on any given day. We are at a bull market phase right now, so being long growth stocks can produce better returns. But if you don't have an exit strategy, they sell off just as quick, a lot quicker. So they require a little bit more nimble of a strategy, a little faster strategy. I think small caps are at resistance. If they can break through this level here and start to extend higher, I'd be a lot more bullish on them. But right now, the Russell is kind of right at resistance. It's got a lot of overhead supply here to work through. And, the fact that everybody's piling into them right now makes me more bearish about it, that this could be a turning point to the downside.
Okay. Any commodities you're looking at as well, Chris, that are perhaps on a verge of transitioning to another phase in the cycle?
We're seeing gold and silver and miners perform fairly well. I mean, they've been rallying up here and they've had a pullback. They're starting to move higher. Gold miners, precious metal miners have a little bit under pressure this week with a strong rally in the dollar. But, if we were to look at what gold miners have been doing over the past year, I actually have a really good chart here for this, which is this bottom area of the chart where there's these red bars and green bars. When the bars are red, this is telling us our strategy, saying the stock market the tide is going down. You do not want to hold stocks. And what's interesting is the gold miners have rallied up while the stock market was out of favor. And then as soon as the stock market got in favor and gave us green bars to like buy the indexes or whatever, we would see gold miners sell off. And so gold miners have been the exact opposite of what the stock market has been doing. And if we go to where we are right now, I do feel like we're going to eventually get some red bars. I think the market is close to reversing its trend in the next week or two. That means we should see gold miners come back up as a defensive play. And this is what happens just before a major stage 4 decline is we find gold, silver, and miners become this really odd defensive play where they rally up really strong while the stock market is not favorable. And it's a short-lived move, but it is one of those extra warning signs telling us, hey, in the past year, gold miners are doing exactly what they've done before major market tops that last years, a correction that could last years for the stock market. So I'm a little bullish here on miners because they're at the 200-day moving average. They've had a nice rally in a pullback, and I do think they're going to go up as that defensive play one more push higher.
Now, the miners, let's just bring up the miners one more time. The GDX, for example, has grossly underperformed gold, not just this year, but over the last 10 years. I mean, gold has more or less retraced its all-time highs, whereas the miners are trading at below 50% their all-time highs in 2011. When you look at a chart like that, what's your first impression?
Yeah, so gold miners should be leading the way. If we were to really start the next major super cycle leg up in the commodity space, gold miners, silver miners should be leading the way. But as we can see here, they are down, 50 or so percent from the highs. Whereas gold is equivalent to trading right up near these highs. It's way up here. And so that to me is a kind of a red flag that, the precious metal space isn't ready yet. I think we could see the miners rally up for a little bit for a month or two. And then I think they're going to roll over and sell off with the stock market. And I think the miners and precious metals will be one of the best plays, like we saw back in the early 2000s, where we could see hundreds and thousands of percent returns on some of the gold miner stocks, tens of thousands of percent return for some of those penny stocks. But we're not there yet. I still think there's short-term upside in gold miners for a month or two, maybe. But I still think there's a lot more pain to come before we start this next big rally that could be huge in terms of percentage on individual gold stocks. So it's coming, but we're not there yet.
Mm-hmm. Finally, let's talk about the dollar, the DXY. Now, it's been trending down throughout 2022, has been consolidating for the better part of 2023. Let's take a look at the charts, and can you give us some analysis on the DXY?
Yeah, so when we saw the 2000 kind of state tech bubble, we saw the US dollar rally up and have a big surge. During the 2008 financial crisis, we saw the dollar have a huge surge. I think we're going to go into another situation in the financial system where we're going to see the dollar have another surge. And I do feel like it's going to come back up into either the 115 area, potentially up into the 120 area. And of course, if we do get that big rally in the dollar, it probably means we're going to see precious metals move down, not only because there's going to be selling across the board in the stock market and margin calls that forces metals lower, but the rising dollar is just going to be like the nail in the coffin that's going to help pull gold prices down. But after that, once we go through this phase, I do feel like we're going to see the dollar sell off for years, just like we saw over here. That is going to send gold, 2,700, 3,500 and beyond. And of course, gold miners will go ballistic. So you and I have talked about this for like the last year. This is a very slow, each bar here is 1 month. So, one tiny little window here is 1 full year. So these type of patterns take a long time to unfold, major super cycles. Yeah. If the dollar does get up here, it is going to be an unbelievable opportunity to take advantage of precious metals and commodities as the dollar falls. It's going to be a really good financial reset to take advantage of.
It does look like that chart is making higher highs throughout the last, you're going back to 2010. So ever since the lows of 2010. So you're expecting still medium-term strength for the dollar.
Yeah.
Okay, very good. Finally, I want to touch on a few of your principles from your book, Asset Revesting. We talked about this briefly last time, but congratulations on the book launch. Tell us about what revesting means.
So revesting is more or less giving the power back to the investor to take their money and move it out of assets that aren't performing and to reinvest it into something that is moving higher. It's all about only holding assets that are going up. So the problem with, you can kind of compare it. Investing, think of investing as like dropping your money, plopping it into the market, and then you just ride that roller coaster and hope when you want to retire, we don't go into a 5-year bear market, right? Whereas revesting is we're constantly reinvesting our capital into the leading and the strongest assets. And if nothing is going up, we're waiting in cash, just collecting interest. So you're actively rotating your money, reinvesting it into solid assets that are trending higher, or taking advantage of falling prices, profiting from declines either in the dollar or in the indexes, things like that.
Could you say that saving your cash, meaning parking it aside for now, is a form of revesting or not so much?
I think so. It's protecting your capital, right? So we've got a large portion of our capital is in cash right now, because as the markets have been rallying up this year, we're scaling out of our positions. You can move them to cash. For example, cash is a position. A lot of people don't see it as a position, but you could park it in an Interactive Brokers account. You could put it in like a short treasury note ETF, like a bill, BIL is the symbol, and you can collect interest every month. So you can put yourself into a position and you are collecting, 4 or 5% return a year on that money when you're sitting in cash. So cash isn't just, wasting your money. You're protecting it, which is the key here. And you're still, growing it very slowly, but you are still growing it. I mean, it's way better to be in a cash position of either making no money or earning a little bit of interest than it is to take a 5 or 10% loss because you just don't want to get out of the market. You feel like you need to be in a trade.
Roughly how much of your position right now is cash?
We're about 75%, I think, position in cash right now.
So I think, we've talked about this before, but for the new viewers watching this right now, they might be wondering, well, Chris, if you're structurally long the markets right now, I know you're bearish, but you're long right now. Why not go all in at any given time? If you're let's say you're very bearish, you're either out completely, 100% cash, or you're short. If you're long right now, instead of being 25% long, why not just 100%? What's wrong with that?
Right. Well, it depends on how you look at it, right? So there's nothing wrong with that from my point of view, because the market has rallied up. Here's the thing. Our accounts, we keep hitting new all-time highs. We're wealthier than we ever have been, yet the stock market is not making new highs. And that's because we move into positions, we lock in gains, we wait for a next setup, we scale out as things go up. So we don't catch a full move. We only catch a small portion of most moves in the market. But because we don't, ride any of those downward moves, we're constantly ratcheting our account up. If we were to just pile in right now and say, oh, we're still long the market, let's go long 100%. Statistically, when you look at even the NASDAQ, when the NASDAQ's rallied 15% from one of our buy signals, usually within a few weeks or a month or so, it has a very big multi-month correction and pullback. And that gives us a new signal in the market to exit whatever remaining position we have. And then when it gives a new buy signal, once that pullback is finished or that consolidation, we can jump back into the market with 100% and ride that next trend that is, a high probability. It's going to have a lot of upward momentum. So right now, to me, is like you're buying near a high. You're buying at a point where there's a very high probability this market could reverse and sell off very sharply, and you could take a really quick loss, in a blink of an eye. So we want to move out as the risk goes higher and higher as we inch closer to a sharp reversal.
It's about measuring probabilities, because I was wondering if you have a rule as to whether or not you're 25 or 50% in at any given time. How do you decide how much to allocate?
Yeah, a lot of it comes down to how much volatility is in the market. You can look at the VIX. We can look at daily price ranges. If there's a lot of volatility, we actually make our position sizes smaller. But we can increase our targets because price can move more percentage wise. So we want to lock in more, but we don't want to put in as much of a position because there's a higher risk that it might not pan out. So it really comes down to volatility. On how volatile the market is, and then we adjust our targets, we adjust our position sizing accordingly. The markets are very dynamic, right? You got to breathe with them. You can't just plop one strategy and think it's going to work in a bull and bear market. It'll hurt.
How do you feel about using leveraged ETFs?
We use them for our band strategy because it's a little bit more of aggressive strategy. We have more positions, and because we're spread out over a few different sectors, we can add a little more leverage. But overall, if it's your investment capital, like my main investment account, I don't use any leverage. I never use leverage. I just don't want to risk my capital with leverage. It can cut both ways very quickly. I have an aggressive account to trade, faster moving stuff. But if I'm moving large amounts of capital, I don't want to see my account move. The indexes can move 3 or 4% a day. Those are, you got leverage on there to watch your entire account move like 8% a day is a pretty severe move, right? So I like to stay in a comfort zone. Leveraged ETFs are great for smaller amounts of money, more aggressive traders. But if you've got a lot of wealth and you just want to make sure you grow it and maintain it and not have a lot of stress, non-leverage is the way to go. We can outperform the markets dramatically with no leverage. The way I actually apply leverage is we trade half of our portfolio based around an SP 500 strategy. We trade the other half of our portfolio based around the NASDAQ. The NASDAQ moves a lot more, has a lot more potential. So the NASDAQ is like trading a leverage play on the index. So that is our leverage without applying a leveraged ETF because they have higher price beta skew. They've got all kinds of problems built to them on their own.
Yeah, for sure. Yeah, it's higher beta play. Chris, if you were to go short on something, whether it be an index or a particular stock, doesn't matter what the case would be, what would you do? How would you execute on that short? Would you just outright short it? Would you buy a put option? Would you buy a short ETF? What's your approach there?
Yeah, I'd buy an inverse ETF. It's the easiest. To me, it's the safest way to do it. Most people don't short. They're scared of shorting. They're not allowed to short. There's unlimited risk with shorting. The ETF is a simple way. You buy an inverse ETF. It goes up the opposite of what the stock market falls. That is kind of the easiest play. And when I do those, I don't use any leverage. Most inverse ETFs are leveraged. Yeah. I like to stick with just SH, which is a non-leveraged inverse of the SP 500. Because keep in mind, when the market falls, it usually falls 3 to 7 times faster than it rises. So a lot of people, for some reason, when the market's going down, they go into the 2 and 3 times ETFs. And I'm like, okay, you're stepping into a really volatile, unstable market, and then you're that has already amplified volatility, and then you're throwing on another 2 or 3 times that. And so people get aggressive at the very wrong moments. When people get aggressive, I'm actually tightening up. And, it's just people's mentality is to try to take full advantage of an opportunity with leverage. And usually emotions take control, and it usually backfires.
And the thing with that is that also I think you're not supposed to hold these inverse or levered ETFs for a long time because there's time decay depending on how it's constructed. If they use options, then there's time decay, right?
Yeah, they lose value. Even if the ETF goes nowhere or the underlying index goes nowhere, the ETF can lose value over time. Yeah, it's kind of like an option almost.
Yeah, excellent. All right. Well, that was a very thorough overview of the markets. We'll follow up again, and there's definitely more to talk about next time. Chris, thank you very much. Where can we follow your work and learn more about your strategies?
Yeah, sure. They can follow me at thetechnicaltraders.com. Or they can go to Amazon. They can search up asset revesting if they want to get a copy of my book and see what it's all about. And that's the strategy that I've been using for 20 plus years. I can consistently refine it. And if you just want consistent growth without the whole volatility roller coaster ride, it really is the ultimate strategy. That's the core focus is make money, don't lose any, and just keep getting wealthier.
You're gonna have to tell us how to manage your time. How do you trade full time and write a book? That's our next interview, time management with Chris Vermeulen. But very impressive stuff. Thanks very much, Chris. We'll put the links down in the description below. Appreciate it. Thanks. Speak to you next time.
All right. Take care, David.
Thank you, and don't forget to subscribe.